Hello everyone, welcome back. Hello everyone, welcome back. So today, I did a lot of research. I realized last time I forgot to set my default audio to my microphone. Like, usually it picks up my gaming microphone or it picks up my good studio microphone. So that was very, very unfortunate. So it took me a long, long time basically to work on this extra content I've been wanting to work on. And so I find that very, very interesting. And I've just been wanting to add to more and more of it. So I'm hoping that they can hear me fine. I'm just going to double check. Testing. Yep, okay. So audio seems to be working on the stream. So that's good. So I worked a lot on this 20-something page Excel. I worked on Excel a lot, but I basically made it into a PowerPoint to summarize the information. And so I could probably go into more and more detail about this later, but it's a big Excel spreadsheet. So I think we should get started. But first things first, like none of this stuff should be taken as a financial advice, because like I find that this game is very, very good with coming out of real life stuff, but at the same time, like this is all just a simulation in an environment, but I related some of it to real life. But there's no perfect way to like evaluate a bond, but a lot of this might be like not completely accurate, but I tried my best to make sure it made sense. And so I find this game can help you in like the game with like determining how to pick bonds and how to pick companies. But in real life, it's probably best to seek out like a financial advisor or do your own research and conclude on that. So we got the Wall Street Raider and Speculator bond research by me. So the table of contents, first before we go into table of contents, I just added this a minute ago. So basically we have, dear Wall Street Users fan, 10.0 is coming out. I think I didn't buy the crypto one for the Wall Street Raider. And so I'm basically waiting for the 2025 release on Steam. So I'm really, really excited for when that comes out. But basically Michael Jenkins, the creator of Wall Street Raider since 1990, is retiring at 81. And Hackjack Games is going to be the publisher, and then the developer is Roin Software and Hackjack Games. So I joined their Discord just a little bit ago. I was up late night and I realized they had a Discord community, so I found that really, really interesting. The bit rate is low, but okay. At least microphone's working. So the table of contents, the terms to maturity and terminology. And when it comes to like the Wall Street Raider on Steam, I'm gonna have to get used to like the new UI, user interface. But I think it'll be exciting because it could potentially make the game grow a lot. And I'm a big fan of that. So the table of contents, terms to maturity and terminology. We got yield curve analysis. So the yield curve with probability of default. And one of my big inspirations, I spent an entire day just going through Aswaf Dormadon, who's a NYU professor, and he had a lot of like interesting stuff on bonds on there, especially with like default rates. Because in the game, I find that my biggest complaint is it's probably in the manual somewhere, or it's probably nowhere to be found, where they share like the risk of investing in certain bonds, or if you're buying like subprime mortgages or prime mortgages, or it's the odds of your default. So I did this mainly for bonds, but I could probably later on do a video and determine like the default rates on like an insurance company, because insurance company in the game, you can do convertible bonds, you can do regular bonds, and you can also do subprimes. And for bank loans, you can do variable business debt. So it's like business bank loans, you can do bonds, you can do consumer loans, and there's just a lot there's a lot in there. So it's gonna probably be a lot more work, but I'm interested in maybe doing that, or at least doing like a insurance company where all I do is convertible bonds, regular bonds, and maybe some subprimes, but I want to come out with like the average default rate and maybe determine whether or not the yield is worth the default rate. So we got the second part of the yield curve analysis. We got yield spreads, CDs, TD, T-bills, and government debt. And then another one is bond duration. So we got Macaulay duration. And unfortunately, this is what I went into on my muted stream. Is I did a YouTuber. I should probably get that up. It's like Ryan. Bond duration. So I used this guy's content, and he has like a little Excel spreadsheet that you can come out with like bond duration, and then like I think this is how you do it manually, which I found very interesting. So basically, I you can either do it manually, but in this case, I did it on Excel. So and then he also comes out with how to come out with modified duration. So the first part of that is modified duration. Government short bond, modified duration, and others. Bond asset allocation. This is one that I worked on just last night. So I'm just like, if you make a bond portfolio, like what's the risk, and like how quick you're gonna get your cash back. And so I did the barbell strategy, which I covered in a bonds and Bitcoin video, which was the unlisted stream where I had my sunglasses on. And I did a bit of barbell, and I did bonds and Bitcoin. So I did like the Bitcoin was like my high risk, so it was like the far end of, think of like a barbell. So they get your right side, which is risky, and then your left side, which is safe. Like there's a middle where like you don't make as much, and like that comes with like regular investing, and I did it with bonds in this case though. So in bond strategies, and then we got yield to call, positive, zero, and negative return. So in Speculator, which I like more for the bond research on yield to call, in the game, in a Wall Street Raider, they don't give you as much bond details like the call price and the call date. I'm pretty sure I can't find that. So I had to get that from Speculator. We get company analysis, so the interest coverage ratio, which I covered in my muted stream, capital expenditures analysis. So this was the company that I grew into like 50 something billion after like 3 hours of playing Wall Street Raider or something, or it was probably a lot less. And we get capital expenditures analysis, so capex to cash, capex in debt and cash flow, weighted average cost of debt, and rising versus fallen angels analysis. So like a rising star would be like a company that's rated junk, but could potentially be investment grade if they get their act together. And fallen angels are like previously investment grade, triple B, that got fallen down to junk. So you could look for a fallen angel and then potentially have it as a rising star. That's like, there's a lot more to that, but I found that very interesting. And we also got financial analysis, so you get the balance sheet, cash flows, organic, and amortized goodwill. So you get organic growth, and then you get amortized goodwill in the game. So if you're buying companies' assets for more, you gotta recognize that, and there's potential risk in that. So I don't like to have too much goodwill in my balance sheet, but it's a good way to grow pretty fast, especially with interest rate swaps. And we got convertible versus straight bonds, and then we got references and other facts. So terms of maturity and terminology. So you can get your short bonds, which are 1 to 3 years. So like that's important for like the barbell strategy. I think some people do 1 to 4 years, and then the 4 to 10 is like the middle, where in the barbell bond strategy you want to probably try to avoid. And then the long term is where like if the yield curve is upward sloping, the short term stuff won't pay very much, but it's low risk. And then you got like the long term stuff, it should pay a lot more. So like that's why you would do the barbell in that case. And I learned a little bit of that yesterday, a little bit more. And then you got premium bonds, so it's over $100, or in this case, I don't know why, but bonds are priced in the hundreds in the game, but in the game, in real life, and when you're buying them, they're actually thousands. So when they're premium, the yield to maturity is less than the coupon. So basically, because you're paying over, like if you're paying 150 and you're getting $50, that's like I think 2.5% or something. And then if it's below par, like you're buying a bond for like $50, it pays 50, then that's where your yield maturity will be higher than the coupon. And when they're at par at 100 or at 1,000, then basically the yield to maturity will equal the coupon. And you got Macaulay duration, which I cover later. So there's just terminology that I wanted to explain. So the Macaulay duration is the weighted average term to the maturity of the bond. So basically, how much time into your cash flows basically pay for the present value, like the price you pay. So 5.76 times means that the average years to hold of the bonds PV of cash flows equals the amount paid for the bond. Modified duration, measurable change in value of security with changes in interest rates. So 2.75 times means that it would fall 2.75% for every 1% change in interest rates. And then there's another thing that I didn't cover, which was bond convexity and effective duration. But I found it kind of interesting to do yield to call, just because what if your bonds get called away? Then if you're relying on that for income in the game, and that your bond gets called away, that's reinvestment risk, because if rates fall and then they get them called away, like you have a lower rate that you're getting. And capex to cash, I made this up, and then capex to debt, I made that up too. I'm pretty sure it's not in financial things, but I found it very interesting. So then capex to cash is just the cash balance of your company divided by yearly capex. You can get that in the cash flow statement. And then the capex to debt, so it's max debt divided by yearly capex. You probably don't want to do that though, because like you'll be rated like junk, or at least triple B, or at most triple B. How many years you have for capital projects? So like that's very, very important, because if you don't want to be growing at like 30-something% and spend all your cash or all your debt in 1 year on capex, and also like you might not get like the best return. So you want to kind of space it out over 5 years or something. So then basis points, for example, 1 basis point is 0.01 and 100 is 1%. That's some terminology that a lot of people use. I'll just say 1% or 0.01%. We got yield to call, how many years until issuer can recall the bond. And we got yield spreads, difference between two bonds with similar maturities but with different credit ratings. Convertible bonds, fixed income security with option feature to buy a fixed amount of common stock. So it's like a hybrid security. You have an option to convert, so it kind of acts like the stock, but you get kind of a best of both worlds almost, where you can get the stock but also have like the safety of debt. And we got the WACC, weighted average cost of capital. In the game, I only did the debt portion because I didn't really feel like calculating the equity. Like you could probably figure that out, but there's a lot of ratios, or there's a lot of like line items in the balance sheet or income statements that you can't get fully in the game. Like they don't have EBITDA in the game, so you kind of gotta make up your own, like, and now like make up your own way of doing things. Like I do that later with like interest coverage, because I think interest coverage is like calculated differently, and I think I talk about that a little later. Probability of default, the likelihood an issuer would fail to meet their debt obligations. So we got yield curve. I'm just gonna turn off my camera. Where's that? So yield curve analysis, government debt. So in the game, you can look at the CD rate, which is the top left. And like I said before about Speculator and Wall Street Raider being different. In Wall Street Raider, they don't give you the CD rate, and they also don't give you the yield to maturity, I'm pretty sure, on a bond, and like how much it is for the car, for how much it is for the call. So basically in less than 2026, is basically the starting year. So like that's your CD rate, and like that's variable, and like it's basically if rates crash, your CD rate would crash. So it's like your term deposit, like your certificate of deposit, or in Canada that'll be GIC. So like they're the safest, but they can also get crashed pretty fast. And we got 2036, so that's the 10-year short government bond. The current yield is 6.86. I made the mistake and I did 6.86, and then I didn't realize the yield to maturity on there. And then 2041, I did yield to maturity for the other government bond that you can buy in the game. So then you get like basically a bit of like if you look at, so like you basically get 6.21 for the CD rate, and then just ignore the current yield. You look at the yield to maturity on the 10-year government bond, which you're locking your money away for 10 years. So you could actually make more potentially on the CD rate than the 10-year. But the 10-year, it gives you a lock-in, which I like. And then if you also look at if you look at the other bond that you can get from the government, it's 7.49. So in this case, yield to maturity would show a inverted yield curve a little bit. So you get like your 6.21 from your CD rate, but you're getting less on the 10-year government bond that you buy. So you would want it kind of be upward sloping, because like you're locking your money in for an extra 10 years. So where the T-bill is 2026 less than 2026, it's greater than the 2036 short-term government bond. And so it's about 25 basis points. So you get 6.21 minus 5.96. So you get about 0.25% extra just for buying the CD rate. So if you think rates aren't gonna crash and like they're potentially gonna go up or stay flat, potentially a CD would be a better option in that game. So yield to maturity is the thing I use for most of the yield curve analysis, but in this case I made a mistake. I looked at the current yield of 6.8, so that's why it makes it look like it's upward sloping, but it's actually downward sloping, if that makes any sense. So then total expected return of the bond if held to maturity, so that's what yield to maturity is. It includes compounding using time value of money, frequency of interest payments, maturity date, and reinvestment of interest. Current yield, coupon divided by market price, tied to the market price of the bond, only used for 2036. So right here, that's the current yield, and that's why I made it look like it's upward sloping, but it's actually in reality downward sloping based on yield to maturity. And a desired rate of return, I'm pretty sure I did this wrong, I'm not too sure, but like you get 0.46 probability of default, and then plus your yield to maturity. So you should theoretically buy your the 2036 at that rate. But these are government bonds, so the likelihood of default is probably a lot lower than 0.46, maybe 0.04. But that's for AAA bonds is 0.04. So like for the AA it's 0.46 per year. And I got that from Aswaf Dormadon, which I credited later on. And then for the long, the yield should be 7.95, because like it's 0.46 average default per year, so you should be getting 7.95 yield to maturity. And you can basically see your odds of default over the long period of time. I'm pretty sure this opens up my Excel, which is a bit of a mess. So we can see like yield curves. Like this is my source, and like it's a mess, so like that's why I decided to make this into a spreadsheet. So we got like references and ideas. So like right here we can get distress from Aswaf Dormadon. We get like the slides where I got the information from. So right here, for example, okay, so then we get like, yeah. So if you click on that, we get like the slideshow, which I got basically if it's a 1 year it's 0.04. And I basically got his distress template. And so like this is like the yield curve that I plotted. And this was 6.84. But like that, if I look right here on the short government bond, 6.84. Oh, I guess I made a mistake there too because the yield to maturity is 5.96. But I did fix it in the PowerPoint. You see right here, 5.96. So this was, everything's not perfect, but I tried my best to make sure everything looks perfect. So we got yield curve on AAA, yield curve on AA. So like you can see, a lot of the times it's upward sloping, or there's occasionally some times where it's like kind of flattening. So like the T-bill rate in Wall Street Radar is 8.68, and then I also looked at these bonds when they were like 11 for the short, and the long was 9. So in that case, like there should be an inversion, but in the game I couldn't really find much. And then for like the single A, like you can see, like there is a bit of an inversion later on with the 2051, because you can see there's 11.88. So, but like it occasionally flattens. But like there are some years where like potentially your yield curve is actually dipping, and so like I incorporated probability to default into it later in my analysis. And then there's a big one that I found very interesting, which was this triple C. So like you can see, like the yield curve kind of flattens and dips every now and again. So like this one's crazy right here. So you get like 8.68% for the T-bill rate, and then you get 16% because your probability default is a lot higher. So like that's why these yield a lot. So there's a big jump from the there's a big jump from the single A to the triple B, and an even bigger jump from the double B, and then a giant jump from the double B. Oh, whatever. Yeah, the triple, like, yeah. But then there's one that's like a giant outlier in the information, which I found is interesting, because like if you look at the triple C 2033, it's yielding 9.85%, but then the T-bill rate, which is risk-free because it's issued by the government, is 8.68. So why would you theoretically buy the 9.85 triple C bond when you can get 8.68 risk-free in the game? So like that's a bit of like the yield curve and probability of default explained. So we got yield curve analysis, AAA corporate bond. So you can see, I did show you that Excel a little bit ago, but like this is kind of a bit more summarized. So 8.75 for the T-bill rule, and then it goes up to 11, 11.56, and then 11.81. So that's like a normal yield curve on the AAA. And you get probability default, which I used Aswoff Dormadon's Excel, which is later on in here. So we can get AAA, 0.04 probability default right here. And then, let's probably put the face cam back on just for a little bit. So we get 0.04 probability default per year. And then that's 0.04. So if you do it over 3 years, you just do that minus that to the power of 3. This was in Aswoff Dormadon's. So if you do it to the power of 20, so if you buy a 20-year, you have a 0.80% chance of losing that money over 20 years. And I guess you could probably theoretically use this stuff over here to the right, but I'm not too sure, because like maybe it's like maybe if you're buying a 30-year, so we could change this to the power of 30. Like, this is why I'm not very strong with this stuff. I literally just learned this a little bit ago. But like for example, if it's to the power of 30 and you do 0.65, there you go. Like that potentially, like I think your analysis could be completely different, because you could go from 0.04% for 1 year probability default, so it's 1.19 for a 30-year. But if you use the higher end at 0.65, that 1% goes to 17%. So like that's just how big of a jump it is from 0.04 per year versus 0.65. So that just shows like in how important like these like small numbers could potentially be. But in this case I just did 0.04, and I did it to the power of 7 and to the power of 15. So like your probability defaults are pretty low in that case. So for your AAA corporate bond, And then we get your double A. So you can see like it's a bit upward sloping, but kind of flattens out some points. But in that case, I would look at maybe the 2047. But then you get your probabilities of default. So like if you're buying the 2051, that's like 25 years. So I did the double A. So the double A has 0.09. You could potentially do 1.03, but it's 0.09 to the power of 25 to get 2.23%. And so like potentially like you might just want to pick the 12.13, which is the 2034. So the 8 year. This is 0.72. Or you could pick like the what's the 12.37, 2047. But like there's a decent jump up there from there. But like yeah, pretty interesting. You also got your yield curve analysis for the A bond. I couldn't find a 1 year, but they get 0.09% probability default per year. And so if you buy the T-bill, and then it kind of like dips a lot from 2045 to 2051. So like and your chances of default go up over time as you buy it. And then your triple B, it basically like the 12.63 is 2034. So in that case, it's 6.30% chance of default. But if you buy the 7 year, which is yielding a bit more, you get less chance of default because it's 1 year less. So like this is investment grade, and then now we go into junk, which goes from basically your triple B goes from 0.81 to 2.85. And like and if you want to be a bit more assured in your analysis, you could do 2.85, which is the lower end for the 1 year, or you could do 4.39. So like let's just go to the double B. So the double B, the high end was 4.39%. And then let's just look at like whatever one we want to choose. In that case, we could probably do the 16 year. Yeah, so the 16 year. Change that to the power of 16. 51%. So if we look at the double B, it's 2.85 on the low end, or it could be 4.39. So if we change this 2.85, the 51% probability default goes down to 37. So basically over time, like you just want to plot the yield curve and then maybe look at like the probabilities of default and then do your analysis based on that, which I find pretty interesting. And we got your single B. Your T-bill rate is 8.65 and then 15.6 for the 2027. So your chance of default is 5.19%. So you could probably come out with like a bit of an estimation. So it'll be 8.68 for the T-bill rate plus the 5.19% chance of default. So you make like 13.87, 15.60 minus 13.87. So you get like an extra 1.73% for the extra 1 year, accounting for the 5% of default. So like you can see basically in some cases it actually might be interesting to pick like the shorter term years. Whereas if you go for like a 2044 or 14 year, you have like 52% chance until when you hold it to maturity that you're gonna lose money. And like there's 15.6% for the 2027, but for 2044 it's 16.12. And in that case, is it worth the extra whatever percent to cover that? I'm not too sure, but it's just interesting. And we get triple C. So and this was where I was talking earlier about basically like why would you buy the 2033? So I said what's wrong with it? Because it's just interesting, because if you look at the T-bill rate, it's 8.68, but then the 2033, which has a 38% chance of default if you hold it to the end, or 6.75, or you could do the higher end, which is, where's triple C? triple C down here, 6.75 on the low end or 8.65. So what was the year on that? It was 2033, which is 7-year. So if we do the higher end, so it's triple C, 6.75 on the low end, 8.50. And then we change that to the, what was it? It was 2033 was 7-year. Change that to the power of 7. So it goes from 46. It goes to 46%. But if you choose the lower end of the triple C, 6.75% versus 8.50, it goes to 69%. So it could potentially be up like an extra 10% if you hold it till the end. If you want to like just like be a bit too extreme and account for like everything going bad, I don't know. Or you could do, in that case, it's the 10-year. You could do the 5-year analysis, which is triple C at 7.57, and if it's a 7-year, it'd be 42%. Or which I would probably use the 10-year, which would be 8.18. So then 72%. But if you want to go the extreme, you could do 8.50. Yep. So you can just see how things change. But in most of this analysis, I literally just did the 1 year, and I did it to the power of the year. So like if it was an 8-year, I did this to the power of 8. So yeah, I just found that pretty interesting. So yeah, I couldn't find any range for the C bond, but there is a C bond, and that's the coupon rate 7.50, and the yield to maturity is 19%. But in Aswaf's template, right here, he only has CAA to triple C plus. He didn't give anything that was lower. And then right here you get the T-bill rate that I found. It's under the interest rate information in Wall Street Radar. So like if you buy a 15-year, which is the most amount I could find, which is 2041, 64% chance of default. And you buy like a 3-year. So like maybe you want a ladder with like the shorter term stuff. And then if you want to risk it, you can do the longer term stuff. So here's like the yield spreads, which I also covered on Excel. So the CD rate is 6.21, the T-bill rate is 8.68. So in this case, I think I used the T-bill rate to come out with yield spreads. So like for example, so we choose the 20 AAA, where's the AAA right here? So we did 11.30 minus 8.68. We get 2.62. So if you buy the 2027 AAA, which is 1 year, then basically the yield spread over the T-bill rate is 2.62. Now I also did like the averages. So like if you look at like the yield curve over the single A, like there's some that like aren't as good. But like if for example the 2045, that one's yielding 12.86. 12.86 minus 8.68. So you get 4.18. And then if you look at the other ones, they're probably, the yield spreads aren't as good. So I just basically did that on the average. I did conditional format in Excel to get the red and the green. So if it was higher than the average, I did it as green, and if it did lower, then I did it red. And then for like the triple B, and then we have like the double B. So if you do like the double B, for example, like the 2042, there's the double B. Oh, it's not in this picture because I ran out of room. And I did the, yeah, that's the yield to maturity. I didn't include that, but yep. Okay, so we do like a single B, which is the 2044. That yields 16.12. Subtract that by 8.68, 7.44. So like that's where I got the 2044. And then I also did conditional formatting based on that. So like in that case it's 7.44. And then there's one that meets the average, which is the 2031. So the 2031 yields 15.62 minus 8.68, 6.94. And we get like the triple C. In the case, I was like, what was, like, if I go back, what's wrong with the triple C bond right here? Like, where's the, there's a big dip. So the triple C bond has a yield spread of 1.17 compared to the 2026 T-bill. So in that case, you get a risk-free at 8.68, but you get 9.85 for a triple C. But for the 2033, you have a 38% chance of default. So in that case, I think I'd rather buy the T-bill in the game. The spread between the 2031 bond is 5.77. Something seems wrong. So like if you look at the 2031, it's 15, and then all of a sudden goes down to 9. With a default rate of 6.75 a year, 38% default to term. And then we get like yield spreads over the government bond. So the CD rate is 6.21 in the game. The short government bond, which I don't think I included in this analysis. Oh yeah, it's right here, so it'll be, so that would be 6.84 minus, and then it was minus the CD rate of 6.21, I think. 6, yeah. And then, like, the thing I made the mistake of a while ago was that, oh yeah, I know, right? Was that, like, that little screenshot in the Excel? Where was it? Was the government? Yeah, so right here is where I made the mistake. Coupon rate is 8 for the short bond. Current yield is 6.94, and then the yield to maturity is 5.96. So then it was right here with the government 6.84, but in the Excel I did 6.94, and yield to maturity is 5.96. So some errors made every now and again, but this did take a lot of work, but I found it pretty interesting. Macaulay duration and modified duration explained. So like I said with this guy right here, he has a video also going over the Excel.
Bond. This one in the example
So I think
will
I have the sound on.
Note you'll receive the
So you just do like the coupon
notional value
for the
of
cash
the
flow.
bond. You have to discount it.
And then you can come
So
up with like the present
1 year.
value. So in this case, like you want to do it discounted by the yield to maturity. So like the present value of your future cash flows, you want to do basically your today's money divided by 1 plus the discount rate, which is the yield to maturity.
To the power. Now let's find which.
And so like for example, based on like the 6% thing, to the power of, where is it? So to the power.
The rest
to like,
of these 1 year to the power.
I'm gonna use an upper to the power of the period. So like for example, like if you do C8, which is $50 discount rate of 6%, and then you do it to the power of 1, but over time you have like your basically your 8 year. So like kind of like what I did with the probability default. So like you get like your present value of your 10 years, and then basically you get your weight-ins. This is the Macaulay. So like for example, your first year you're gonna make 5%, 5%, 5%, then 4. The reason why it's going down and then it goes up a lot is because like when you get your money back at 1,060. Oh yeah, I should probably take off the camera again. So then in that case, like you're getting most of your money back on the 10th year, but like because you're discounted by the yield to maturity, it's basically going down to 4%. So you basically see your present values going down, but then when you get your 1,060 back for the 10th year, so you get period times weight. So you do your period times the weight, 0.005, and then you just sum that up. So it's 7.885. So right here I did the Macaulay. Yeah. So I explained the Macaulay duration and the modified duration again. So like I use the short bond at 1.70 in this analysis instead of using the higher ones. So we have one company, I don't know how to pronounce that, but it's got 3 years to maturity. Yield to maturity is 5.41, so that's the discount rate based on the present value. And then you also get your coupon rate. So your coupon rate is for the cash flow, and then you discount it by 5.41. And you get your modified duration by doing a few things. Like I think you basically get your Macaulay, and then you divide it. Like I think I actually have that somewhere. So like in order to come out with modified, you do your Macaulay divide by. I should probably zoom that in. So it's like your Macaulay duration divided by 1 plus your discount rate divided by 2 because it pays semi-annual. So in that case, we get like the modified duration, which is like the potential volatility for interest rate changes, which I found pretty interesting. And so in that Ryan guy's video, he also has like a video where he plots like a simple like bond price thing. In that case, I actually can probably show some of that. So it's like this is what he did, is he basically did F6 for the current yield, which is 5.37. Then if you do, it's a little complicated because like I'm not a CFP or no, not CFA. In this case, he did 1 plus the price, or no, 1 plus the yield minus the when the yields go down. So it'll be 5.37 minus that times J something, which is the Macaulay duration, times the current price. So basically, as you can see, you can basically plot that into a graph, which I did on the Excel. No, which I did on the PowerPoint. So in this case, you can see it's 9.25 at par. So like it's right there at about 5%, and right there in the middle. So you could potentially, if rates fall down to 2% about, or less than 2, you can make 1,033. So you can make a decent profit, and then you could lose a lot if it goes down to 12. But in this case, I think I explained later on that there's also something called bond convexity, and I looked up on AI, and they suggested that apparently convexity is a more accurate thing, because in this case I'm assuming big changes, because we have a 5.41 yield to maturity, so at 9.25 for the bond, and we're making the rates go up like 7%, and like basically the modified duration assumes a linear relationship, but convexity doesn't assume a linear relationship of bonds. So I didn't cover that, but I could probably figure out bond convexity and make it into a Excel sheet on here, hopefully. But like I said before, maybe there's not all the information I have and I need. So I'm just trying to simplify this game and like go over some of the analysis that you could look at. So for example, like you could look at like this one's a 3-year up here, and then you get a 20-year, a 23-year. So you can just see like the volatility potentially, because like this one's like going down a lot. Like it's like not as sharp as the drop, but in this case, if you're buying the 6.93, so it's about right here. So you're buying about 1,060. You could potentially, if rates go down to 2, you can make 1,700, or you could be having $47 of bond value if it goes near 15 something percent. So like that just shows like the risk, because like right here it's going to 700 on the whenever rates go up very high. That's because like basically a 3-year bond is less volatile because you're getting your money back in 3 years, while you're locking your money up for 23 years in the switch and reinsurance. But you can make potentially way more gains. Like in this case, you're only getting 925 buy-in, and you're making $1,033. So if you do 1,033 minus 925, and in this case it's 6 dot something, so you're buying for 1,060. and then you could potentially make 1,700. But in that case, I'm using modified duration, which assumes a linear relationship, and convexity I think would be a bit more of a better analysis. Yeah. So modified duration on the short bond. This is where I get the AI source, which I found interesting. So it talks about convexity. Convexity is a mathematical concept in fixed income portfolio management. It is used to compare a bond's upside price potential with downside risk. It builds on modified duration, which is a measure that examines the bond's price sensitivity to changes in interest rates, but, however, has a caveat. It assumes that bond prices and interest rates have a constant linear relationship, which in reality is not the case. Convexity aims to resolve this by accounting for any effect that interest rates could potentially have on a bond's duration, and therefore measures the rate change and duration. Yeah. So I got this from AI. I was just generally curious. I used Google Gemini, and I was just curious whether or not convexity was more accurate or modified duration was more accurate. And in this source, it's basically saying that convexity is nonlinear, and then with the modified duration, it assumes a linear relationship, which is not the case in the game. Convexity is a measure that is similar to the modified duration, estimates the bond's sensitivity. However, modified duration assumes a linear relationship. So I found that pretty interesting. Yes, convexity is generally considered more comprehensive measure of bond sensitivity to interest rate changes. So what I did right here, probably not the best gauge. It's like this thing, but like it's a rough gauge. But like in this case, I'm using big changes in interest rates, and it says right here, when those changes are significant, while modified duration provides a useful estimated price change for small interest rate shifts, it underestimates the impact of large changes due to the non-linear relationship between, So in this case, the short bond, I got like basically $60 based on the coupon rate, discounted by 5.37, and then you get like your present value, and then so you're getting 60%, 7 times Macaulay duration, modified duration is 7.65. So if you, like in this case, I forgot to include the numbers in this one. Dang it. So in this case, I didn't calculate bond convexity, so thus this wouldn't be too accurate. So like it's just something to consider. And then in this case, I also got probability of default because it's a AA 0.46. Desired yield to maturity. So like your yield to maturity is 5.37. You add the default rate, so then you get 5.83. So you would want the bond price to fall a bit more before you buy. And then desired coupon would be 6.46. And in this case, I would probably want to consider the yield to maturity because that will probably be more accurate. Couldn't find the yield to default based on government. I actually, because like in that Aswaf thing, he didn't really cover. I don't think he covered government default rates, or I just assumed like the corporate AA, I think. Modified duration others, so we get basically you can see like a 7-year. That's when things start changing a lot. So I think there's an Intelligent Investor book which I was reading, and they said like you probably want to buy a max of 7-year, because if you're buying like the long duration, like you'll potentially make a lot, but if rates go against you, you could lose a lot. I don't know what page that is in Intelligent Investor, but 2020 something I was learning about that, and I just found that kind of interesting. So like you can just see right here with the 3-year, like it's not that volatile, but then there's a big change between the 3 to 7-year, and then the 10-year, and the 10-year government. So like you can see like this isn't dropping as much, but like the line changes a lot for like after 7 years, especially for the 20-year government. And we get desired rate of return for this, so you get your yield to maturity plus 0.77% chance of default. AA was 0.73. These numbers aren't entirely right, but I found this stuff just interesting though, so I wanted to share. So this is what I worked on last night, and I found this pretty interesting. So like this also might not be entirely correct, but basically you can look through, you could basically like come out of the Macaulay duration, you can come out with the modified duration, and like what if you want to weight your portfolio in different ways. Like this is like your bond asset allocation idea. So like for example, we get your typical barbell, which I covered earlier on. So like you get your 1 to 3 year, and then your 10 year, and then you get your middle, which is 4 to 10 years. So in the case of that, I did sub middle. Uh-oh, my bad. So in that case, I did the 3 and 10 year. So the 3 years are short, the 10 year is the long, assuming 50-50. So like the Macaulay, which I did last night. I'll put the camera on. Once I go back into probability default, I'll take it off. But we got right here 50-50 weightings. So like your Macaulay for the 3 year will be 2.92, and then your 10-year government short bond would be. So like this is like a mixed strategy. Like you could look at barbell with like the corporates, but unfortunately there's only the 10 year, which is considered the short government bond. And in that case, it's like I said before, if it's above 10 years, it's considered long. So like you can look at the 10 year and the 20 year, but you're not really comparing, like you're doing like the long end and the long end. So I did say in this analysis I chose some intermediates. So I chose some higher than 4 years, and I did some 7 year right here. I did the 8 year. But so like this isn't really exactly barbell, but it's interesting because you could look at like the short term, which is less than 5 years, or in the upper source it's like 1 to 4 or 1 to 3. Yeah. So then if you weight it 50-50, so you get your Macaulay, so then you weight average that, so you do basically you do 50 sorry basically you have 50%, and you times that by your Macaulay 2.92, and then you add that, and then you do your bracket. So you do bracket 50% times your 2.92, and the bracket in Excel, and then you do plus bracket 50 times Macaulay, and the bracket, hit enter, so then you get the weighted averages. So in this case it's 5.39. So if you're buying a 3 and a 10 year, you would make your money back in 5.39 years, or the modified duration would be 5.25. So basically, every 1% change will be 5% change, like a 5% change in value. And if you choose the 8-year corporate and the 20-year government, so you're choosing kind of like an intermediate bond and then a long, you can see your Macaulay goes up and your modified goes up. So that's assuming the 50-50 change. And then you get your barbell strategy mixed. So like this is a 7-year corp, 25% weighted. 25, 50, 75, 100%. So you just choose a big mix in. So 5.42% for the Macaulay for the corporate, 7.86 for the government. And you choose another corp, 6.99. And you choose the 20-year government. Your weighted average, so you do 25 times your 5.42 plus all this other. And you get 8.05 and then 7.75. So you can see like if it might be better to buy, if you're worried about rates going up, it might be better to buy the 8 and the 20, and instead of having like all this big mix. But in this case, this would be less volatile, and you would get your money back quicker than the 8 and the 20. So you think rates are going to fall, you could choose the 8 year, get your money back in 8 years on the 7-year, 8-year corp, and in the 20-year government, you're locking your money in for the long term, assuming that you're going to have a rising yield curve. So like that's why you don't really want to choose the middle, which I found pretty interesting. And then you get your barbell strategy for corporate bonds. So you get 3 and a 10 year, 4.90. So if you choose the 3 and 10, so if you're choosing potentially the 3-year corp and then the 10-year government, 5.39, 5.25. So theoretically, I think the government bonds in this game, I think they typically offer less yield to maturities, and they offer less coupons than the corporate, just because like there's less risk. So I think in this game, because the corporates yield more and they have a higher yield to maturity, you make your money back sooner. So like right here, you get the 10-year government at 7.86 and 7.65, and then it's 7.06 for the corporate versus 7.62. So like weighted average, you would basically get your money back a little bit sooner with the corporates, but you also got to account for the default risk. So like the government, I find interesting too. And then you get like your years for the corporate, 4 and 15. So if you're choosing like the 4-year, which is almost considered medium, like I think it depends. Like I get other sources that say like the short term is less than 5 years, or it's 1 to 3 years for the short. Because like in that other case, yeah. So, and you're choosing like an 8 and a 20. You get your money back in like 7 years, and so like it just changes all the volatility. And then the bottom is bond laddering. So you choose a 1 year, 2 year, 3 year, 4 year, 5 year. So the 1 year, the Macaulay would be 1 because you're getting money back in like 1 year, and then you discount that by the yield to maturity, so you get 0.95 modified. And the 2 year, 3 year, 4 year, 5 year, you weight average that 2.78. So if you're choosing like the 3 and 10, it's 5.39, versus if you're laddering, it's 2.78 Macaulay, and then if it's modified, it's 2.62. So if you're thinking that interest rates in the game are going to go up, you want to choose the laddering strat over the barbell. But if you think rates have kind of peaked, you could do the barbell strat and potentially make almost double. It looks like it's 5.25 for the modified, and then 2.62 for the laddering. So that's why in the game, like earlier with my bond only series, I did some bond laddering whenever rates were like 1.71% on the short bond, but whenever the interest rates would be like above 8 on the short bond, I would consider adding duration. So that's where I would probably incorporate the long ends. So I might do the 8 and the 20, or the 8 and 20, or the 4 and 15, just choosing like the longer end because I want rates to go down. And like, but yeah. So laddering your spreading your maturity dates to minimize interest rate risk, increasing the liquidity, and diversifying your credit risk. But like the big thing in there is you're minimizing your interest rate risk, because like you're only doing 1 to 5 years in this case, so you're modifying your Macaulays a lot lower than if you're choosing the longer duration. So you're choosing like an 8 and 10. That's a lot riskier. So the barbell, hold in short and long term, avoiding the intermediate to benefit from higher yields and reduce interest rate risk. So I'm going to turn off the camera. Right over here to the right, assuming that you're choosing investment grade bonds only, AAA to BBB. So I looked at the yield curve analysis. Where was that? It was right here. So I just chose the AAA, chose the 2041, chose the 2041, chose the 2042 in this case because there was no 2041 for the single A, and for the triple B I chose 2041. So I'm kind of comparing apples to apples, besides the whole fact that there's no 2042 for the single A. So in this case, 2041, 2041, 2042, that's the A. So then you get like your weightings, because there's 4 of them, so you're choosing like the long-term stuff. You could theoretically plot in there like the shorter term stuff if you really wanted to, but I want to look at longer term stuff. So like if your probability default for the AAA is 0.60, which I use 0.04 to the power of 2041 minus 2026 because that's your starting year. And then for the AA it's 1.31, and if you choose a triple B, 2041 minus 2026, so I do that to the power of 0.81, so you get 11, and then for the A, it's 2042 minus 2026, So it's 0.36. So then you get 5. So your probability of default, the average would be 4.75%. So that's if you're holding it for 2041 and then the 2042, that one. So the weighted average is they're basically the same. So that's why on the bottom I didn't choose to do the weighted average, because I basically saw these two were equal and the same. So if you're choosing a mix of investment grade and high yield, so you're choosing a 2041, 2041, 2041, AAA, AA, triple B, and then a triple C. And then the 2042s, because there's no 2041s for the single A and the double B and the B. So that's why I did that. And I weighted it based on like calculating it to 100. So I just did 100 divided by 1, 2, 3, 4, 5, 6, 7. So you have 7 hold-ins in this case. And I weighted average that. So you get 26% over from 2026 to 2044, it looks like. But most of them are mature in 2041, and then some of them 2042, and then one of them is 2044. So your average probability per year is 2.2. So like that's why I feel like a lot of people, they buy the bonds for safety, because in this case you're buying the investment grade and you're only losing your probability of default per year is 0.32. But then if you're buying the junk stuff, it's 2.2. And junk bonds have two names. They're high yield or junk bonds. Because the reason why I call them junk bonds is because they have such a high probability default. And if you're choosing junk bonds only, that's where things jump pretty big. Because like in this case, it's 4.75 over the term, 26 for the mixed. And if you're only choosing junk, then that's a little scary, because it's 2039, 2039, 2041. So you get average per year 4.93% probability default. So you would hope that the coupon would be for these bonds pretty high compared to the coupon for the triple A to account for that risk. So I couldn't get anything lower than triple C, and also the Azwaf Dormadon template. He also doesn't have anything lower than that. Like if you look, he has triple C. He doesn't have anything double C. He doesn't have anything C, and he doesn't have anything D. So like that's the junkiest of the junk I could calculate for the probability default, which I found interesting. But if you do it over the term, so you have 3 hold-ins, 48% over the term, so, and then you get 4.93% chance of default. So you can just look, if you're buying like the long end of things, you probably want to look at like having either a mix of the investment grade if you want the higher risk, but probably not do the junks unless you want like a higher return potentially. Because like if you looked way back on the yield spread, so like if you're looking at the investment grade, it's like 11, then 11, then 11, then 13 for the triple B, and then it jumps a little bit to the B, then to the B, then the triple C, it jumps quite a lot. But I keep doing that. Yeah. So it's just an interesting thing. Like you want to look at like the yield to maturity and determine whether or not it's based on do desired rate of return and calculate whether or not it's worth it. But in that case, I would probably just buy the investment grades in the game. Okay. So we get your yield to call, which is only really on Speculator, because for some reason you can't get the bond quotations. Maybe I'm wrong. Maybe Wall Street Reader, they gave out bond quotations, but in Speculator they gave out bond quotations. So we get 5.55 for the coupon rate, 6.87. So we want to do the 5.55, which is the coupon rate, and the face value payment $55.50 based on the coupon, and then the N, which is 5, assuming it's a yearly bond, but in this case it's a 10 because it's 2040. I think it was 2025 when the year started, so it's 5 yearly payments or 10 semi-annual, and I think it says right here it pays semi-annual. Probably don't. No, okay. I assume it paid semi-annual. So the bond price is 811. So you can see it right here. It's not actually 811. It's 800 and so it's 879. But yeah. Like I paused the game, and when you pause the game, like rates change and everything changes. So that's why there's a bit of discrepancy in this analysis. Like, but you can solve yield to call or rate. So if you're buying it below par, which is 811, and then the call price is $1,050. So if you're buying it below par at 811 or around 879, then basically it's 5.69%. Your yield to maturity is, yeah, so like it's 7.79, but it's 6.87. So there's a bit of discrepancy, but at the call scenario, so you're buying the bond at 1,050, and then in 10 years you're going to call it away at 1,050. Because when rates fall, like in the game, you could choose to call back your bonds for 1,050, because maybe instead of getting a 5.55% coupon, your company can issue debt at like 3 or 4. So like in that case, the company will call it back. So then you'll get 2.64. So like basically you're getting 10 payments of $27. And premium, so you're paying like $1,250, and it's getting called back for $1,050, but you get 10 payments of 27. So like that's how you're getting 0.67% yield. And then if you get zero yield to call. So how to come up with the zero yield to call? I did basically the payment times the number, so it'll be 27.75 to the power of 10 plus the call price. So then you get 1,327.50. So 27.75 times 10, $277.50. So that will be interest. Plus the call price of 1,050, you get 1,327. So you're gonna be making a 0% return if you buy it at 1,327.50, and then you'll make a negative yield to call if you're buying it at 1,500, because you're only getting 1,327, and 277 of that is interest, and 1,050 of that is being called away. Because like if you look at it, it's below par, and then par price is 1,000. So they're giving you an extra $50 just to call it away. But if you're paying above the par, or 1,000, 1,500 for the bond, you can get a negative return. So we get company analysis, interest coverage. So like I find this is very, very helpful in the game for, like I also covered this on my muted stream. I found that pretty interesting. So in company analysis, interest coverage. So if you look in the cash flow, I think in real life, this is where the interest coverage right here. In real life, it's EBIT divided by interest expense, but in the game, I kind of had to, I don't know, make my own number up for the interest coverage. So I did total taxable income divided by interest expense. So you get your total taxable income, so you get your net profit from business operations at $636. Your T-bills, which are going to be pretty consistent, but like rates could crash or they could go up, so you could potentially make more or less. Same for the business operations, but like those two are pretty consistent. But then the worry is in their income statement, you get their profit of loss on interest rate swaps at 615, so you get 983.46. So you do 983.46 divided by 140, because you got their expense on their bank loan and then their bonds issued, so you get 140. So in this case, this company has 7 times interest coverage. So if you look over here, interest coverage, they're like in between single A and triple B. But in this case, like they're a little bit better than triple B, so I would probably give them a triple B plus, or maybe if they're closer to 8 or closer to 9, I'll give them triple B plus. So like they're almost at the point of triple B plus, I would think. Because like it's higher than 6.1, but it's lower than 9.6. Yeah. And so then my worry though is if the interest rate swap income crashes to like nothing, because it's only 363. I forgot to do the plus 5.46, but assuming that they have no T-bill income, 636 divided by 140, 2.59. So in that case, it would be B. So if we look over here, 2.59 coverage would be single B. So like that's the worry about interest rate swaps in the game, because if they go against you, like potentially your income's going to crash and then your coverage is going to go down a lot, and like you'll be basically downgraded, especially if your balance sheet's garbage. But then also I found it interesting in the mute stream. There's total coverage and then there's bond coverage. So if we really wanted to, really wanted to, I guess I can come out with the total coverage actually. So it'd be 5.46 plus the 363 divided by 140. So it'd be 2.63 actually, but it'll still be junk, which is like the B, so like that'll be scary. But in this case, you can get the bond coverage, so it'll be 983.46. Divide that by, so if you want to do the bank loan coverage or the bond coverage would be 42.61. So the bond coverage looks really, really good. It's 23 times, but if you do 983.46 and then you divide it by 97.92, they got 10 times coverage on the bank loan. So if you include those two, you get 7 times the interest coverage. But their bond coverage is very, very good, and that's fixed. But my big concern there is that most of their debt is based on variable bank loans. So if rates are going to go down in the future, that's good. But if you think rates are going to go up, then that's concerning. And that's also the one I did in the muted stream. I basically came up with the interest coverage, and I came up with like the bond coverage. So we also got CapEx analysis. This is the one that I made up, and then there's also CapEx to cash flow, which is an actual ratio in real life. So a greater than 1 means that the company's operations are generating the cash necessary to fund its asset acquisitions. Ratio less than 1 indicates the company is having issues with cash flows to purchase company assets. So I did this in the muted stream. Like I did interest rate swaps, and I wanted to make sure I had at least 5 years capital projects. Because like if they're a junk company, and if they're junk and you want them to be unjunk, like it seems like but my big concern is if they keep throwing money into capital projects that are less than their WACC, which I cover also WACC later on. But in this case, this one company over here in the top left, they're paying $13.70 a quarter for UPS times 4, $5,480,000,000. They have $3.6 billion in cash. So the years that they will run out of cash is 243 days. And I think how I came out with that. What's it? That's probably somewhere. But like basically I did yeah, it actually explains it right here. My bad. So the cash, 5,000. So you do 3.6 divided by 5.4, 0.66 years, or times that by 365. You get less than 243 days of capex till they run out of cash, and then they have to take out debt for their capex. Each purchase of PPE and amortization of goodwill will likely make this number lower, meaning it's a good start for allocating capital projects over time. So like as this company keeps growing, like if they have amortization of goodwill, or they're buying like $13.70 per quarter and they're growing like 5%, like basically it will compound over time. So then $13.70 and they're growing that at 0.05, that'll be an extra $68 million. So like this isn't completely accurate because it doesn't account for the compounding of the goodwill of amortization and everything else, but it's a rough gauge of like how long you're going to be until your projects run out of cash. So like I like to keep it above 5 because like if you're doing interest rate swaps, you want to have at least 5 years before rates go back up, and then your interest rate swaps are going to make you big income. Like in that case, right here, it's making you big income, but if it's not making you big income in the game, then basically that can be concerning for the capex to cash ratio. But in this case, the company is getting 650 million, so they could use that towards more capex, or to build up their cash balance and make their capex to cash look better. So I like to have 5 years, and I like to buy the interest rate swaps, like do like you're betting that rates are going to go up below 3 to 4%, and then you're basically printing money at like, but the ideal rate is like below 1.5. And then capex to cash flow in this case, so we look at the company, it's 496 a quarter for, which company did I do that for? And divide it by the operating profit. Where's the operating? I don't know which company I did this for. I think I did for this one right here, but like the numbers are a little off. I don't really know. So then the capex to cash for BGen would be the cash right here. So you do their cash plus the T-bills, 9,000, and then they're putting 496 million. So I guess it would be BGen, because yeah. So where's their op? Yeah, so I guess it is BGen over here. So like all this is BGen. So then BGen has 0.13 times capex to operating cash flow. So in this case, like it's not a 1, so it means like it's not too safe. And the capex to cash for BGen, the cash is 9.6 billion, and so you get capex to cash of 4.87. But based on their operating cash flow, it's a little bit risky. And then capex to total debt, you can look at them. BGen can borrow $159 billion. So their total debt, years of capex. So they're doing 1980. So it'd be 496 times 4. Yeah, so 1984 a year. They're doing 496 a quarter. So when you do like the 159 billion divided by that, you get 80 years of capex to like debt. So like if you want the company to have zero debt, have maxed out debt, my bad, then basically that's where they would start hitting junk. But because they're AAA, like they have lots of debt that they could potentially take out. So the capex to debt is really good, but the capex to cash isn't very good. And if you're assuming 50% debt, it's 40 years, 30%, 24 years. So in that case, BGen has a very, very good capex to debt. Not so great capex to cash, but I think it's just the bare minimum for me. But the capex to operate is a little concerning. So like those are 3 things you could look at when it comes to like growing your company and choosing capital projects over a time period. So we get the fun thing, which is interesting, is like this is something I'm not too sure about, because like it can be hard determining a fallen angel or a rising star. So a possible fallen angel is this triple B company. They have 0 line of credit debt left. So the weighted average cost of capital. So like they got 152 million in corporate bonds, a bank loan of 228, 380. You get their interest rate, so it's 7.71. And the concern that I would say that this would be a fallen angel is negative 1% PPE return. So basically, they're borrowing for 7.71 on their debt. And for the WACC, I did not include basically the common stock. So if they pay a dividend, then like I didn't include that. But like if you're looking at your debt mix, basically in this case, the WACC is 7.71, and you're making negative 1 on your capital projects. And then there's also another thing you can look at is return on invested capital, which is a little bit more complicated. But in this case, I only looked at PPE versus the WACC. So if the WACC is so if the return on capital is above 7.71, that provides value to the company based on its pre-tax. Looking at cash flows can be helpful too, based on ROIC. Just ignore that because I did not do ROIC. I did PPE versus WACC. So this company looks very, very debt burdened because like their projects that they're investing in aren't generating the WACC, basically, like their weighted average cost of debt. So in this case, I also looked at their interest rate coverage, which is 3.06 of operating income divided by 7.32 of 7.32 of their debt mix, 0.41 times. So that's a little concerning too. Like if it's a 1 times, and like basically that'll be 7.32 and then 7.32, and like in that game I would like to look for above a 3. Like if we look right here, above a 3 would be like double B, or it would be, in this case, this would be like a single B. So in this case, like if it's 0.41, like this company is basically should be based on their interest coverage. And I got this from Aswoff. Right here. I included these two. Oh. Yeah. So if it's 0.41, this company should be trading at C something, but I forgot what the credit rating was because I forgot to take it. Oh, it was triple B. So in reality, this bond should be a triple C, because if you look at the coverage, it's 0.41, but it's a triple B. And then the capex to cash, so it's 42.6 million divided by planned capex for the year. So it'll be basically they have 111 days of basically cash until they run out of money, and they also have 0 line of credit left. So that's my big concern, because like if you look over here for the interest coverage, 3.06 divided by their mix of everything, 7.32. So like that's how I got 0.41 basically. And we look at the possible rise in Star. This is a double B company. They have limited line of credit left, which is my big concern. So they don't have a lot of room to move. So it could be a possible rise in Star, but what if the economy doesn't do that well? But if everything goes correct and everything goes right in their department, potentially BST in this game could raise from a double B to a triple B, whereas this one could get a potential downgrade. So we look at the WACC for BST. So most of their money is in a bank loan, which is also my big concern, because like their corporate bond is 8.2, which is still a pretty high interest rate for a corporate, but like it's 14. And plus I also looked at these when they're different interest rates, so like based on the economy, so like that's why things are so much different. Like I forgot the interest rate, like the short and the long. I think this was when interest rates were like 1%, I would guess, on the short and long, on the short, and this was something where the interest rates were a lot higher. But if you still look though, the PPE return is 14.3, or a 1.19% spread over the debt. So the interest coverage would be 2.26. Oh. So then 2.26. So it should be like a little bit higher than a single B, but it's not double B. So in that case, like it's still a little bit concerning, but at least they have better coverage than the other company. And then the capex to cash is 194 days versus 111. And the operating cash flow would be 0.34. So that's my very big concern. If you look over here, the operating cash flow is 1267, and then their capex I didn't include in the screenshot, but it was 431. So it's 0.34, like basically capex to operating cash flow. So it's still scary because it's not meeting a 1. Credit rating BB, unused line of C, line of credit. So then the debt to equity is also 1.13. So like I was looking at other ones, and they were like 1.5 debt to equity, and this bond was trading near par. So I think I picked out a potential rising star, but there was also other companies I could have looked at that were potentially a rising star. So my concern with the rising star is the capex they are using, liquidity is low. So if you look at the company over here, basically, so like if you look at the cash right here, it's 133, and the short-term T-bills is 298. I didn't include the AR or the inventory, so you could theoretically include that, but what if their accounts receivable, they get nothing because they're a supplier that, like the person that owes the money, they don't give them any, or they don't collect on the entire amount. So then there's also not too much of a healthy spread. Yeah. So like a 1.19% spread is a little bit concerning too. Because if you look over here, it's 13% for their debt based on the WACC, and they're getting 14.3. But if interest rates crash and then their PPE return stays the same, this could potentially be a rising star. So this was the one that I looked at when it came to. This is also the one that I looked at when it came to like my muted stream that I did. I grew the company, and so I included all of this in the muted stream, but I decided to summarize it into this slideshow. So we get the bonds and the bank loan. So if you look at it, we're kind of an even mix in that case, which is good. But then our bank rate and our bond rate. So the bank rate was higher than the bond rate because we got a good fixed rate on our debt. So the WACC was 9.99. And then that case in the muted stream, our capital return was 23. So we have a very, very good spread of 13.91. So basically we're making money on our capital projects at 23, and potentially the capital projects could not return as much later on in the future, but we still got a healthy WACC. So there's a good spread there. So like when it comes to this company, it's not as healthy of a spread. It's 1.19. And we also got taxable income business analysis. So earlier on, I like to make most of my money from interest rate swaps, so that way I could put into capex for business operations and have a giant cash balance. But it's scary because like in that case of the muted stream, 87% of my income from business was coming from swaps. So like that was scary. And it was like in this case, where was that? This is also really, really scary right here. It's 615. So we could potentially come out of how much of their business operations. So it'll be 615 divided by 983.46. 62% of this company's basically taxable income is coming from swaps. So if the interest rate swaps crash, that's why I'm assuming that the company is going to potentially become junk if they make nothing off of swaps in the future. So like it's very, very important to have a mix. So like in the start, I like to build my company up fast by using interest rate swaps, which is the primary income source. When you start off with less than $1 billion, you can't do any swaps in the game. So I got those numbers from a mute stream. And then we got my organic versus unorganic growth. So the organic growth would be you have your company and you set a 5% growth rate, or you're buying like assets and you're getting like a tax deduction, but it's mainly just from like a 5% growth. You look at like your capex, which is over here, which was like over here, for example, your capex. So like your capex is organic because you're growing it, but you can also like look at the company. So the organic is basically where you're growing your company and you don't have any potential for goodwill write-downs because you're paying fair market value. But for the amortization of goodwill, there's a potential for like goodwill amortization, like get something called an impairment of goodwill. So if we look over here, PPE, So we got 36 billion, and we have goodwill at 26% or 13 billion. So if these 13 billion of assets we've paid over the book value become not as worth it, we could potentially see a giant haircut in that. So it's important to have more organic growth than the amortization of goodwill. But if you want to grow fast, you want to probably use amortization of goodwill. Yeah. So in this case, capital projects, asset allocation, I like to keep it below 30% for the goodwill. If you really want to be conservative, you could do less than 10%. And then have like 90% of your PPE coming from like organic growth or just projects that you already have. And we also get your balance sheet allocation. So you get cash, $0. In that case, I had $0, but I had 6.8 billion in T-bills. So that's about 11% cash, which is a pretty good buffer in case the swaps don't do that well. Accounts receivable at 5.99. So if you include that, it's 17% in cash, really. But there's something called the current ratio, which doesn't include AR. And like if you see right here, where was it? Over here, you can see the working capital AR inventory, 2.3 billion. So it's AR and inventory. So the current ratio, it only includes inventory. But in this case, there's two different names for the working capital. It's AR and inventory. So in this case, for the quick ratio, it's 11%. But then for the current ratio, it's 17%. And they're like in the game, like this is where I also made it up too, because like a current ratio of 1 means that like you have like 1%, you have like $1 in current assets. So like it's basically cash, T-bills, AR, and then you have $1 in current liabilities, which could be like accounts payable and everything else. But there's no accounts payable in the game, so like this is where I kind of make things up. So the PPE 60%, the goodwill is 22. So total assets is 82%, and then your cash is 17, including the accounts receivable and your T-bills and stuff. So then you get 59 billion. So most of my money is coming from property, plant, and equipment, which makes sense. The capital structure is almost evenly mixed between variable and everything. And then the 87% of the income comes from interest rate swaps, which is concerning. 60% of our business right here is coming from non-organic growth, but 26% of our asset allocation is goodwill. So I'm worried about impairment, but at the same time, like, yeah, in our growth of our company over time, like the impairment is risky because like we're doing 60% of our capex towards towards amortization of goodwill, and we're not doing much organic growth. But in our balance sheet, if you look over, that's in our cash flow. This is our balance sheet. Basically, we have good coverage in our balance sheet, but we don't have good coverage in the So we get company analysis, convertible versus straight bond. So this is a little bit different because the convertible bond is a 6-year, and then the straight bond is a 5. And then there's also like a double B versus a double A, so it's not really comparing apples to apples. I could probably compare it, but also the convertible bonds have a lower correlation to changes in interest rate because they come with a stock option, so meaning that they're less sensitive to interest rates because they follow the stock. So in this case, we have for the convertible 5.12 because this is for a 6-year, and this is 4.2. I wish I picked a 5 and a 5 for both, but whatever. So I couldn't find similar maturities. So like, and plus like in the RBC source later on, they say like basically there's a lower correlation to changes in interest rates with the convertible. So I just found that kind of interesting. And so for the convertible, your yield to maturity is 6.03, but then for the straight bond, it's 9.39%. So you might be asking, like, why does the convertible pay less than the straight? Well, the convertible, you can basically convert it to common stock. So if the company grows, I should put my light on. It's getting dark. Yep. So if we look over here, basically, yeah, like that has a lower yield to maturity because like it's you can convert it to common shares later on, but for the straight bond, you're just getting interest income, and for the potential of rates going down and you making money. But for the convertible, it's less correlated to things. So here's the convertible versus straight bond analysis. So you get a General Mills bond, and that's convertible, so it's above par in this case. So that's why the yield to maturity is lower than the coupon. You're paying $1,100. And then in this case, the Barclays Bank, its yield to maturity is higher because it's trading below par. And then General Mills bond. So like in Speculator also, they give you more details about like the conversion price and everything else. In Wall Street Radar, they just show like the price of the bond, like it's like above par or whatever. But like this one also, but in Speculator, it shows like how much of a break even per share it has to be. So in this case, General Mills has to be above 2070. So if it goes up to like $50 a share, your convertible bond is going to go up a lot. But if it stays at 2070, it will trade at par. But like it also can change based on the interest rates and everything else. So like that's why your yield to maturity is 2.06. And like I said, the game, whenever you pause, like sometimes it changes. So like that's why you're seeing 2.06 for the yield to maturity, and this one's 2.42. So not completely apples to apples comparison, but it's still interesting. And then right here we got General Mills. So you can see like why you probably want to buy the convertible. So we look at the WACC 6.64, the PPE is 21. So because it's a convertible, you can get for common stock later on. So we want to kind of look at all the functions of the company and determine if it's a buy. Well, as with if it's just a straight bond, you probably just want to look at like the interest coverage and a few other things. But with a convertible, you want to look at all the potential for the upside in the game. So like 6.64, 6.44 for the WACC, 21% for the PPE. For the WACC, I only did it based on the debt, not the common shares. So you get a 15% spread. There's a good coverage and interest rate coverage. So it's 3 times, and it's an Investopedia suggests for manufacturing companies, which are known as cyclical stocks. When the economy turns bad, they are heavily affected. Utilities aren't as cyclical as restaurants. So like if you think about utilities, you gotta pay your power bill every month, or else you're in big shit. But cyclical companies, like restaurants, you can choose whether or not you want to get a burrito or Taco Bell, whatever. So ideally, you want to have above 3 coverage for a cyclical company like a restaurant. But if you look at a utilities company, like they might have 1 coverage because their income is way more stable. Like their PPE would be more stable in return. So they have 3 times coverage for General Mills, which is good. So it beats the bare minimum. You've got cash balance of 41,000, planned yearly capex of 3.7. So you got 11 years planned capex to cash. The book value per share is $9.50. So if you look at the conversion price for the bond is $20.70. So it's like double the book value for the convertible. But the market price is $21. So that makes sense on like why the yield to maturity is so low, because you're paying $21 and the conversion's at 2070. So in that case, the call option that you get when you buy the convertible is in the money, because you're paying $21 for the common shares now. That's the market price, but you have the option to get it for 2070. Price to earnings is 23 times. So that's a little bit concerning because like it's not too much of a value company below 14 times earnings. Dividend yield on the common share is 0.09. So like that's a very, very important thing to consider with income. Is like you could look at like in real life they have something called preferred shares. So if you look at like preferred shares, they might have a good yield compared to the common stock. But in this case, we have a dividend yield for the common at 0.09, and then the yield to maturity on the corporate bond that's convertible to stock is 2.42. So you can basically come up with a spread there. 2.42 minus 0.09. So in this case, you're making an extra 2.33% if you buy the convertible. So in that case, it's very, very interesting. The yield to maturity is higher than the dividend yield. So the convertible bond is higher than the equity. So you basically you're getting a higher dividend yield on the convertible. Gotta be more quiet because it's getting there. So basically you get a higher yield on the convertible, which is also like a bond. So it's like a hybrid. Whereas with the common shares, they're not as safe. But still, even if the price of the convertible crashes, if the market price falls to 10, then you would theoretically see the yield to maturity go up a lot. Other things to consider: yield to maturity is higher than the common dividend yield. You get a hybrid debt versus risky common shares. The WACC can change when they refinance bonds and when often variable bank loans change. Return on PPE can change with the shifts in the economy. They have 0.66 debt to equity, triple B for General Mills. So it's $108 million they can use for the unused lines of credit. Helpful for liquidity. And then here's the references. Lots and lots of references. So we got Investopedia, so I might as well close all these. So right here is Investopedia, where you can get basically convertible bond definitions. And then we got weighted average cost of capital. It's company's average after cost debt, common stock, preferred stock, bonds, and other forms of debt. So I did not include the common stock and preferred because the common stock would have been probably too hard to do. There's no preferred stock, so I just did bonds and bank loans to come up with the WACC. And this is used to determine the rate of return, required rate of return. Yeah. And then we get bond ratings. So you can get junk bonds are double B to D, and the investment grades are triple A to triple B. You get Aswaf-Dormandon's thing. I think I went through this a few times, but I did end up using this and this. And I could have theoretically looked at this if the company is not rated, but in the game they do give out ratings. So if your company is larger than 5 billion and you have over 8 coverage, then it's AAA. And then if it's a small company, you want to have over 12 times coverage. But in this case, in the game, you cannot find unrated bonds. I'm pretty sure there's no such thing as unrated bonds in the game. And we get the distress template. So you can basically see a bunch of Aswaf's handy stuff. So I'm looking for distress. So this spreadsheet allows you to estimate the probability of distress from a bond price of a company. So if you click on that, you get basically a rough outline. And this is the rough outline he gives you. And that's how I figured out to the tower of what. And then we get government default rates. So I did say earlier there was probably no government default rates, but I forgot what page I said it was on. It was 37. So right here we get your sovereign, so AAA. I'm pretty sure in the game I couldn't find any government bonds that were AAA, because I think in real life actually the U.S. government got downgraded to AA from AAA. And one of the firms actually just was the last to do it recently. And so that's how I got the 0.46 in the earlier analysis. So where was it? Right here. This is how I came up with the desired rate of return, because they are AA for the I don't know why I did it to AAA then. No errors and my mistakes. I didn't know how to spot these until just now, but yeah, that's like how I came up with the probability default for basically for the government debt. But you could probably assume it's 0% and be okay, but it's still good to assume that maybe everything will go bad. Then we did that. Understand bonds. So I found this very, very interesting. Understanding risk in bonds. So we can see like his lecture. So like this is kind of like the Macaulay duration. I think he doesn't do the percents based on it. It's still interesting. And then I got the default rates from here. Like I spent the entire day just going through a bunch of his bond lectures in order to come up with content for this. Yeah. And then we get value in bonds from him.
10 years left. Things get a little coupon rate. Not surprising. So let's introduce another.
Yeah, you also get convexity, which he covers on there. But I didn't include convexity in my analysis. And then you can also get other default rates for like there's probably different spreads you can use. Like for example, for the AAA you can do 0.6, 0.75, 0.4. But for AAA it is 0.04. But he does for AAA you can give 0.65, 0.41, 0.16. And that's from one of his other lectures, but this is from a different lecture. So that was... Did I already watch that video? Yeah, I did. Okay. Short, medium, and long-term bonds. So this is where I got my short, medium, and long-term bonds for the barbell strategy. So bonds that fall within 1 to 3 years, and the longs are greater than 10, and then 4 to 10 is the medium. And other sources, like I said, they have different definitions for short, medium, and long. So like that's why I incorporated different types for the analysis. Interest coverage on Investopedia. So you do EBIT divided by interest expense, and I had to make that up in the game because they don't have EBIT in the game. But EBIT in the game would be like basically your cash flow, your taxable operations. And it says somewhere 3 times. A low ratio, for example, when a company's interest rate is 1.5 or lower, it can only cover its obligations. A maximum of 1.5 times. A low ratio. Yeah, so I think there's a 3 times suggested in here. Maybe that's a different source. Macaulay. So this is how I got the Excel spreadsheet with like the values that change over time. So you discount it to the period, like I said.
But we found weight each period. It will be.
You sum that up to get 100%.
How many years?
And period times weight.
Is actually 6.7.
And yeah, so that was final car. This was what the explanation of above par, below pars were. So a below par refers to a bond trading below its fair face value. So below 100. Oh. Quick ratio. Company's quick ratios, ability to immediately meet short-term obligations, and its most recent. So it's also known as the asset test ratio. Here it is, quick assets divided by current liabilities, but there's no current liabilities in the game. So I just kind of made up a different ratio for the quick. Like I just looked at like the total cash percent as opposed to all the assets. Like I said that, I did that earlier. And this is what I was saying earlier about goodwill impairment charge. I didn't really cover it much, but impairment charge in accounting entry used for business write-offs. So like a popular one in real life was the Kraft Heinz. I remember this when it came out. This was like years and years ago. Nope. So like AI is saying that in 2019 they took a $15 billion impairment charge due to its overvalue of Oscar Mayer's brands following its merger. This write-down reflected a big decline in expected future cash flows from these brands, largely attributed to the aggressive cost cutting. So like the stock fell a lot. I guess there was also an Aswoff on here about Kraft Heinz lessons. This is extra things you can look at. Oh my gosh, yeah. Yeah, I guess that's interesting too. You can look at that lecture or that material. Effective duration, didn't include this in my analysis, but effective duration is a calculation for bonds that have embedded options. So like they can call it away. Yep. Bond convexity didn't include, but it also talks about convexity is the curvature in the connection between bond prices and interest rates. It reflects the rate in which it's a way to depict risk-reward relationship in a bond. And like you can see, like the duration, typical duration modified is straight line. Was if you look at like this, it's like curving in different. Bond duration, where's the linear? I'm pretty sure there's a word linear. Linear relationship. Bond convexity doesn't assume a linear. Get negative convexity, which I find is a little bit tricky. I gotta learn more about that. But some interesting things to know about. Modified duration, I use this. So modified duration is 1% change in interest rates, how volatile it will be. And the formula looks a lot more complicated than actually using it on Excel, so that's why I use Excel for the Ryan guy right here. And look at Macaulay duration, oh my goodness. Like this is why I used Excel in Ryan's video, because that seems a lot easier than inputting all this in. I learned this like during 2023 when I took a break from YouTube for a while, so I found that pretty interesting. So like I even during my break, I was still trying to develop my learning. We get risk-free rate, so like that's your T-bill rate and your CD rate in the game. So the risk-free rate signals investment has no risk, which means the investor will not lose money. U.S. Treasuries are often risk-free assets that are backed by the full faith of the government. But even in the game, like you can have government bonds. Like these are almost risk-free to a certain extent, like if you're buying the 2036 or the 2041. But you have like interest rate risk, whereas if you're buying the 1 year T-bill, like you're have less risk in that case. Because like you're getting your money back in a year versus with PV, so present value. Present value is the base concept of the sum of money in hands today. It's probably worth more than the sum of money in the future because it is invested and earn a return in the meantime. So like that's why in that case with right here, this is why we discount money from the future for today. So like that's why we use this discount rate of yield to maturity. So like for example, in 10 years, you're going to be getting $1,060. That's 10 years from now. So we'll discount it by 5% to the power of 10 to basically get less money because you're right now you're getting 56. And we got the distress template. We have Wall Street Raider and Speculator, bond analysis. So this links to my Excels. This links to the game. So there's a few sites that have it. Like this is the base game that you can download. And I think there's a demo too. And we have my friend Rake and M, or Clipknot, I think his YouTube channel is. And his content's very, very interesting. A while ago I covered his bond cancellation strategy. And in the muted stream, I did the bond cancellation strategy. So I just find that very, very interesting because you can like look at his little video too. And like he's gone into more detail about like the difficulty levels, because I'm a noob and honestly I play mostly on level 1. But that's just because like I just mainly like to get in this game for like the interest. Yeah. But like you can look over here. So like for example, like this bond right here, it's 2030 and it's $593. Six three 6361. So theoretically in this game, like the reason why the bond cancellation strategy in my opinion is awesome is like you can issue your bonds at a very, very low rate. Like when in the short bonds like at 1%, and right here in the game they're at 7%. So in that case you can call back these bonds, buy them back actually, not call them I think. You can pay 377. So we do 593 minus 397 I think it was. So you make $196 million in profit, which will go towards your cash flow, and then that makes your stock price boom because you're basically buying your bonds for less than par. So like that's a very, very interesting strategy that I learned from him in order to like basically grow my companies a lot quicker. Because before I would think I would just keep the bonds until maturity, but now I know I can do bond cancellation to make a bit of extra money. And when rates go back down, you can issue them and rinse and repeat the strat. So I really, really enjoyed Rick and M's video about that. So then there's the game for Speculator 2. And then we also got the Steam game. So I'm really, really, really looking forward to when this comes out in this year. It might be delayed, but at the same time I'm hoping it doesn't get delayed. And like as you can see, the UI is looking a lot different, so it's going to be interesting when this game comes out on Steam. But it's definitely going to be a bit of a learning curve for me because the UI looks a lot more different than the base game if you've played the base game. But at the same time, like I feel like this being on Steam is going to make it grow a lot, and so I'm really, really looking forward to it. And on my Steam profile, because I'm not logged in on the website, I do have it added to my wish list, and I look forward to when they come out with the game. Because then I can actually do Bitcoin and stuff. Because in the base game on Wall Street Raider, I did not buy the Bitcoin one, because I'm really, really interested for when this comes out in 2025 or a little bit later, hopefully this year. And like as you can see, it's like the minimum requirements are really, really nice. So if you have a potato computer, this game's gonna run. So like Windows XP is the recommended OS. Dual core, which is like nothing nowadays. Very, very limited amount of RAM needed, and very, very limited amount of storage needed. So I'm really, really looking forward to basically when this comes out. Starting January 1st, 2024, the Steam client will only support Windows 10 and later. Then we get bond laddering and barbell. So bond laddering, portfolios, different maturity dates. Watch a video about it. For example, Puerto Rico bond, Poplar. Downsides of the bond ladder. I guess there's probably a reinvestment risk. Yeah, right here. Bond ladders require ongoing management and reinvestment. As bonds mature, investors need to decide how to reinvest the proceeds to maintain the ladder structure. Additionally, if interest rates are unfavorable when reinvestment options arise, investor may face lower yields on their bonds, though some of these bonds are all rolled into new funds. So here's an example. So you get a 2023 bond, 2024, 2025, 2026. da da da. And we got your barbell. Let's see an example. Oh, just give it an example. Yeah, like that's what I was saying earlier about the barbell. It's high risk and non-risk assets. So, for example, like in the game, you could choose Bitcoin as your high risk, and then T-bills as your short risk, or like just laddering, and then that's just an interesting strategy. Like I could probably do in the game on Speculator because I have the Bitcoin update. I could theoretically do laddering for a bit, like half my portfolio and half the other portfolio for Bitcoin, and try that out. Maybe just do barbell only. That would be a fun little challenge. There's also the bullet strategy, which I didn't cover. And these are all different, and it's interesting about the bullet, but I didn't cover the bullet. But I think I covered the bullet a while ago in another stream. So it's just where you choose just all for 1 year or something like that. Like if you want to choose like a 2027, so you do 2027, 2027. Then we get yield spreads. Probably close some tabs. I don't have a lot of RAM. Yield spreads are measured in basis points. For example, a 5-year treasury bond and a 30-year at 6. So yeah. Calculate yield to call in Excel. So this is a video that I looked at on how to calculate yield to call in Excel. So he does PMT 80 divided by 2 because it's semi-annual, $40. Face value. So the bond is being called away for $1,100, but in the game it's $1,050. And you get the number of payments, and then you get your present value, so how much you're paying for it now, and you can come up with the yield for that. But he also does it on Excel, I think, too. Oh, and he also has the Texas Instrument Calculator, which makes me very, very jealous because I can't find a way to get that on my computer. But you can do this in Excel too, which is good. Where's that? Right here. It's one of the templates I used for him. Okay. Yeah, so that was pretty helpful for calculating yield to call. And current yield versus yield to maturity. Bonds or debt instruments. Current yield is the annual income, the interest rates. Yield to maturity is the total return. Talks about what current return is. So current yield is just a coupon divided by bond price. Very, very easy to calculate. Yield to maturity is a lot more complicated, but thankfully in the game they give it to you. And capex to cash flow. This is the thing I covered. So operating expenses, buildings, lands, etc. This is what your capex is being used for. But there's no also depreciation in the game, so I kind of had to modify the capex to the operating expenses in the game because there's no depreciation. Got Fallen Angels versus, yeah. So this is where I probably got it a little bit wrong, but IO bonds are referred to as junk. Bonds that are described as Fallen Angels are simply ones that were previously considered to be investment grade but now considered junk. So in that case, we're looking at, where was it? Fallen Angel. So like this is a possible one. This is investment grade, but honestly, in my opinion, if things don't go well for it, it could potentially be a fallen angel and be categorized as junk. Get the curves right in. I think there's Rising Star in here. On the other hand, Rising Stars are bonds that are considered speculation grade when issued, since improved their financials, reducing the risk. So while Rising Stars are junk bonds for now, there's a good chance that they're not going to always remain as junk bonds. So in the game, I think that this double B could potentially be a Rising Star. other source. So this was the source I was talking about earlier with the convertible. So where was it? Right here. This was where I got their source from. So convertible bonds have lower correlation to changes in interest rates with stock options, making them less sensitive. So right here, convertible bond sensitivity to underlying share price would decrease, or not decrease. Yeah, so I just found that pretty interesting. And, I think that's the last source. Yeah, that's the last source it looks like. I'm pretty sure I covered all the sources I did. Like maybe there's a few, but I probably paraphrased it in my own words to cover it, but I'm very, very sure I covered all my bases for the sources. And so I think this was a lot of work, and I'm looking forward to just, yeah, we'll probably do another summary video on this, but that covers mostly everything I think in the game you need to know about bonds and everything. So I'm pretty impressed with what I did. And I guess we could probably mess around with this template a little bit just for some fun, but like it's getting kind of late, so I'm probably not gonna do it for long. So like maybe let's just do some junk bonds just for fun. Let's open up the show. Okay, I actually have a game. The 19 save is where I did most of my analysis for everything. So if you can see right here, it's 11%. Where was it? Yield curve, 1102. In the game, it's 1111, so it's a little bit off. But in the game, let's just say that like we could probably do like a barbell strat if we really wanted to. If you look at like probabilities of default too. Where is it? So like for example, we have a $1 billion company. So if we wanted to, we could probably do like an insurance company or a financial. We could probably just do a bank, for example, not take out the maximum leverage. Let's just do $1 billion. We just don't really care about the name. So right now we got stock portfolio of $1 billion. We got our company. So we need to keep about 1,800 in liquidity. 4,500 is in there. And our big concern with the bank is their CDs. So these are like variable rate. So like if interest rates keep going up, like and we buy something fixed rate, like bonds and everything, we're in trouble. So we could theoretically do 4.5 billion of the 7.2. So we got 6,300. So we could theoretically almost do like 900 million in bonds, and we could do 4.5 billion for like. We just basically need to keep 1,800. So we could probably just do like a mix of bank loans if we wanted to, or we could just buy some bonds in this game. So 7,200 minus 1,800. So we get about a budget of 5.4 billion. So we can probably look at like a corporate and then just incorporate everything that we learned. So let's just say that I'm worried that interest rates go up because when I paused the game and I tried buying max leverage, like I went 2 billion and then I bought as many as possible. But we could probably just buy, maybe let's just do half, like so 2.5 billion into the long bond. So like you can see right here, there's a AA and there's another AA. So like the 2049, there's different numbers. Triple B, JP Morgan. So if you really want to, we could plot the yield curve out a lot easier by just doing this, but it's a lot of work because you can't categorize it by the year. So that's why it took me so long to do this. So like for example, if you're looking at AAAs, 2027, 2031, 2040, 41. So you can see the 2027 is 11, and if you're buying the 2031, which is like 4 years out, you're getting less yield. But then if you're buying it 10 years out more from there, then you're getting more yield in the 20s, 30, 27. So this is why I plotted out the yield curve, but you can see the year, it's not exactly the same because you can't plot it out as easily. Like we could probably do like a triple B and buy like 2.5 billion and then do, so we had 4.5 billion of debt, so we did 2.2 billion and then maybe do 2.2 billion of bank loans, which can be paid back at any time and are variable. So if interest rates go up, then we're not in as much trouble. Okay. So 13.82 for the 2039, I think I'm liking. Do the 12.79. That doesn't yield as much. Let's just do this one, why not? So okay. 2039. So the current year is 2036. 2026, my bad. So 2039 minus 2026, that's a 13 year. We probably just get rid of the credit rating specifications and just do a long duration just for fun. So we do a 25 year for 2 billion on. Let's just choose this double A because it's yielding more than the single. So this is 2049 minus 2026, 23 years. So we do have a 23 year. So we could theoretically just make a copy. And okay, so it's 70. And to come out with the coupon, we could do $77.50. And we would spray that down because this is a 23 year. I get our principal back at the end of the year. And the yield to maturity is 12.29. Coupon rate is 7.75. This is a double A. And so when you do that, you can see just how over the 23 years, like the 1,077 we're getting is today worth $74. So yeah, and we sum that. Here, so we do the present value divided by the total. So we get Macaulay of 9. And then so we have 8 modified duration. What was it previously with the other one? It was 11, and then it was 12, and that. Okay, so now we can come up with the interest coverage because this is an insurance company, thankfully not a bank. So I think it was EBIT. So it's 6810 divided by 595, 11 times coverage. So I would feel pretty comfortable on this one. So let's go ahead. And we have 8.5 times duration, like modified. So let's just do 2250. It's trading below par, so we can probably do a little bit more. Yeah, so we'll be buying that. We bought 3.2 billion, so we bought 3.2 billion because it was below par. 7.75 bonds, 2049, and we bought it for 2.1 billion and 30 million accrued interest. So we're gonna make our money back in 9 years, and it'll be 8.5 times. So if interest rates keep going up, we're gonna get a little bit destroyed, but that'll be interesting. So it was a 2049, right? so it's a 2049, and it is a double A. So we'll go to double A. Assume 0.09 for a double A. So if it's a, I forgot the year, it's 2049 minus 2026, 23 years. So we have about 2% chance of default over the term, or if we're very, very bearish on the double A, we could theoretically choose 1.03. So it goes from 0.09 to that. How many years was it? It was a 23, so we could probably just do double A 0.7. I guess we could probably do 0.7 in that case. But in that case, I could probably just use the 0.12 in that case. No, right? 0.12. 0.09, my bad. Okay, so it's like 2% chance of default. So yeah, and they have 11 times coverage, so I'm feeling pretty comfortable with that. And then we have 5.5 billion. When interest rates crash, I'll just probably $1,800. So we got an extra 3 billion. We could probably buy half that to some government, just for comparison. But they don't give the yield to maturity, like I said earlier. Okay, so I guess corporates are the way to go. So we could probably just do 3.2 billion in bank loans, and we're set. So bank loans. So maybe 1,600 for both. And we could probably look at the spread on them. So 1.2, I'm guessing that's fine. We pay a bit over par for that. And I might as well calculate the NIM. And I think that's it. Oh, some extra billion. Okay. So we might as well start recording. This is also other sources I did. But we could probably just calculate like the NIM. So let's see. Corporate bond yield to maturity was 12. And we get the bank loan. So we got 2 bank loans, and we can probably just do some T-bills. So the bank loan would be right here, freeze. See, it's 12 for one. And the other one's 10.75. We get the values. So the 12, we have about 1,082.20. We got 1217.20. Then for the bond, 2.1. And for the T-bills, we got 5,000. T-bill rate 9.48. Okay, so we'll probably come out with interest rate. This is what I was saying earlier about doing the brackets. Plus bracket times bracket times are we getting a dollar figure? I want a percentage. Oh, that's weird. Oh, we have to come out the weight. I'm so silly, man. Sorry about that. Okay. That should be 100. Bracket. Oops. Times so we choose this other number. Change that to percent. There we go. That's what I wanted. Okay, so there's our weighted average interest rate that we're getting. Then we go TD rate is 1.90. We just get the NIM, net interest margin. Do that. That. So right now our bank is losing 1.25% a year because we bought a mix of assets. Some of them are yielding 12, some of them are yielding 12, 10, and some of them are yielding 9, the T-bills. So based on that mix, we lose 1.25. And we probably look at, if we really wanted to go extreme, we could look at right here the spread on the bank loans. So for example, so our first bank loan is 13.25. Our next one was 11.25. Come up the spreads based on that. So we get this minus CD rate. So in that case, the triple A, in this case, we're actually losing money on the triple A. And maybe all the other ones are yielding about the same. So in this case, the triple B is like still making us money. And if we really wanted to, we could probably assume like probabilities of default for, so like the triple B was 0.81. So the one that we're making money is 0.81. And the other one was triple A was 0.04. So now we could probably just do our return minus return locked it. My bad. I'm like, why is this so different? Yeah, I'm making this way longer than it needs to be. 11.29, so we're making 14. Yeah. So I'm worried that our bank is actually going to lose money because of this. Probably because we have so much cash, like 53% of our money's in cash. So we could theoretically do. Oh, no, we have demand deposits of $5 billion, so we're probably just going to chill out. Maybe grow the bank at 10% a year. Like have public depositors take money and put money in the demand deposits. Or we're just going to try to keep liquidity above $5 billion. Okay, now we can play. Now we're losing. Now we should be able to. Yeah, we're losing $4.50 a share. It's like the reason why I'm probably getting that is because of the NIM. Annual overhead is 2% because we have 10% growth. And the interest rates are going to go up. Oh, now they're going to go down. So our prudent insurance bond should be. Nope, the market value is lower than the face value. Okay. I should have bought the government then, but whatever. If interest rates continue to crash, whatever. And like I said before, we calculated 8.5 on the modified, 9 years, so 2026 plus 9 years. So we're making our money back in like 2035, and then the 2049 minus 2026. So we get like 20 and minus the 9 modified Macaulay. So about 14 years of that will be interest. So now we just wait for rates to drop, and unfortunately as they drop, like our bank loans are going to be less profitable. Change the NIM. Like the corporate bond's not going to change, the bank loans are going to change. So that was our AA, so I probably should bold that. So then, for example, I forgot which one was which. It was the one with the negative spread, which was 11.25. I'm making errors, but as you see, as rates go down, like our profits are going down for them, but we're adding more bank loans. So I'm not too concerned about if interest rates go up because $2 billion of our money is basically variable, and then 4.7 is variable, but we have a fixed bond that's giving us 12%. We'll make our money back in 9 years. So then let's just keep playing. Yeah. So there's a lot to look at in the game. Like you can calculate your NIM, and it was negative, but there's a lot of moving parts to that. Like in my other stream that I unlisted, I just had to constantly change the NIM and make assumptions. And for example, like we could probably have a better NIM, but not account for the default risk if we went for subprimes and prime mortgages, and we went for like consumer loans. Like if we picked a mix of that, then we could theoretically have more liquidity too, but we'd have higher default rates. So we could probably come up with like the weighted average. Like we have AA right here, and then we have like freeze bank loans. So one of the companies just paid back all the bank loan too. So that's reinvestment risk to a certain extent because they just pay back the loan, and we paid over par for the business. But if they choose to like take out loans in the future, so the extra 6% over face value is probably worth it. We were making good rates on that, but they paid it back fast, and now our bank is just collapsing. We're making $54 million a quarter. Increase our bad debt reserve, but our stock is just tanking, and that's because rates have gone up. So we had $2 billion market value, and then now it's 1,700. So right now rates are at 12. I should have. Yeah, I didn't change this, so I don't really know what the market value was. But it's 54, and I think we paid 65. So we like lost a bit. So we're down pretty big on our bond portfolios. That's why our stock is tanking. And we don't have as much bank loans as variable, but we do have a lot of liquidity. So it's like 1545 plus 6755, 8 billion minus the 6200. So we got like 2 billion in excess of liquidity thanks to the one person that called back the bank loan, like the person that wanted the bank loan gone. So we could theoretically go and buy an extra 2 billion bank loans. It's like we have a pretty, like we're not very diversified anymore. So we'd probably do 2 billion if we really wanted to towards more bank loans. But then I would have to calculate like the NIM again. And like I have to calculate the NIM constantly in order to come out with something good. So I guess we could buy an extra 2 billion of the triple B, get a decent spread hopefully over the CD rate. So we pay 103 over par. So now we get where we don't have exact liquidity, but we're pretty good. And yeah, so we can cover most of our variable if things get bad. But I'll have to calculate the NIM. So hopefully we'll make. So as rates climb, these business loans are going to make us more money because they're variable. Probably do some bad debt reserves too. 16 to 16. See what I mean? Like I think they were like 12 and 10 before. So like, it's nice having some bank loans in there too for your bank. But I want to know the probability of default for them. Our corporate bond isn't doing as well. I guess I could look at the coverage. See if it's been deteriorating. No, I think it was 11 times. $23 times, yeah. So like the coverage has actually gone up since then. So I'm not too worried about them. Like I think they. Oh, that's not my company. We're still double A. The coverage has gone up. So like that's a few things that you can do. Like that's just applying what I learned. Just wanted to save that. And we had like a 2% chance of default, so 23 million in profits, 46 million in bad debt. Yeah, we have just enough liquidity. Now rates are crashing, so our market price for our bond is going up. Unfortunately, we didn't go into long duration as much as we should have. Should have probably picked some governments and some other corporates, but yeah. So now our market value of our bonds almost above par. We paid 65 for it. Now it's 84. So, but for some reason the face value is lower than the market value. But I think we paid. Oh, I can't see. I think we paid like 2,100. So as the rates are crashing, like we're getting good returns, like 8% about for every 1% change. But like I said before, convexity is a bit more accurate. So that's why I probably didn't also want to do that percent change. Now we're in the money on this bond. Oh yeah, because the long bond is below 7. Now it's gonna go probably back up. 63 mil. Now our companies. Yeah, we're in a little loss, but we're okay. But we did pay 65 for it. It's almost at par, 98 right now. And it was 9 years, still 9 years for money to get back, so 21.6. 2035 we should have everything back, but ideally if rates fall down to below 1, we're just going to sell that bond and maybe go into consumer loans. But like I said, I spent more of my time on the Excel and like the Word and the PowerPoint than actually playing, so I feel bad, but I'm just applying what we covered a little. rates are going back up, so our market value is going down. You get the point. So I think that's good enough. 63. I was hoping that rates would go down to 1, but it looks like they're going to stay flat. So I think that covers mostly everything. And if you have any questions, make sure to let me know. But I think it's almost time for me to go to bed because I have to go to work tomorrow. But I did work on this PowerPoint a long time, and I was pretty happy with that. Anyways, you guys have a great Saturday, Sunday, and I'll see you later.